Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. Just as everyone is sighing a breath of relief as tech stocks appear to be stabilizing, the European picture, especially in the UK, is starting to look wobbly. So, as usual, there's no respite for those that follow markets. We write about the latest developments in the UK and its impact on Brexit. We also have published articles on using Bitcoin to time your re-entry to stocks and how the FBI can interfere with US elections. As you can tell, we always make sure we have something that you haven't read anywhere else before. To access all of these articles, all of our archive, and our lively Slack channel, you can become a member on macrohive.com. The first month is free, and then after that, it's only the cost of a few weekly cappuccinos. And if you want something a bit more in-depth with trade ideas and models, drop me an email at bilal@macrohive.com, and then I can tell you more. I'm always on the lookout for podcast guests with unconventional backgrounds, and on this episode, we have one such guest, Lyn Alden. Lyn has an academic background in engineering and currently works at an aviation simulation facility. But on top of her day job, she's developed a widely followed framework for investing in markets. Her approach is value with a global macro overlay, and she's been doing this research for over 15 years. I learned a lot in our conversation, and I'm sure you will too. So welcome, Lyn, to our podcast. It's a great pleasure to have you on.
Oh, thanks for having me.
Great. One thing I just wanted to get out of the way before we start talking about markets is your background. So you have an engineering training and you work for an engineering company as well, yet you also cover markets. And, I guess I just wanted to ask, just kind of more from a philosophical perspective, what do you find in engineering that helps you look at markets?
So part of it's just the same kind of quantitative background. So engineers have a very kind of quantitative way of thinking about things. So that's, that kind of foundation is helpful. And then more specifically, my background comes primarily from controls engineering. So it's about analyzing a system with hundreds of inputs and outputs and seeing how they all work together. So for any sort of input from one area, you might have a response from another area in the system. And that's kind of the same sort of dynamic we see in macro systems, where every time you have a shock happen to some place, you have a policy response, or you have some sort of other response happen. And so I feel like that kind of mindset kind of carries over pretty well, especially to the macro side. And then also it helps to some extent with tech stocks or industrial stock analysis.
Yeah, I've certainly seen that in the work that I've seen of yours. You really do have a very kind of logical way of looking at things. I'd kind of urge our listeners to actually take a look at your work. I guess maybe one point we could start off with is, obviously we've had this huge tech rally in recent years, and in the very short term over the summer, we've seen this correction now as well, of course. But, what do you think are some of the differences between the tech rally that we've seen in recent years versus the dot-com period?
Yes, I think there are a lot of similarities, but there are a couple differences. So one of the big differences is the equity risk premium. So if you look back in the 90s, interest rates were still pretty high. I mean, they were 5-6%, and investors were still piling into those tech stocks at any price. And that of course was a bubble. That was the lowest ever equity risk premium in the markets. And that took a long time to work out, especially for the tech stocks. Many of them didn't recover for 15, 20 years or more. Whereas now, in some ways, it makes more sense because more of those companies have strong cash flows. More of those companies have a lot of the fundamentals to justify pretty high valuations. And we have interest rates that are all-time record lows. So the equity risk premium, even though stock valuations are pretty high by historical standards, equity risk premiums are not that high by historical standards because the S&P 500 dividend yield, for example, is higher than the 10-year treasury, which doesn't happen too often. So all these kind of different ways to measure it. So it's a more interesting environment now. And actually, I think the best historical analog is probably the Nifty 50s, kind of that big collection of a few dozen blue chip stocks in the 1960s that investors thought you could buy them at any price. So it wasn't quite the same level of bubbleness as the 2000 dot-com bubble, but it was this feeling of, okay, interest rates are super low. These stocks are super good. They're just going to keep winning. You can just buy them at any price. And of course, what happened was most of those stocks did very well over the next 10, 20, 30 years, but their stock prices didn't do very well for the next 10, 15 years after that kind of late 60s period. And I think that's probably, looking at that alongside the dot-com bubbles, the closer comparison to what we see today.
And then how have you been trading or analyzing or picking some of the tech stocks over the past few years? I mean, have you been going long, sort of the tech side? Have you taken some chips off the table, so to speak, recently? I mean, how have you been trading it over the past couple of years?
Yeah, so we had that quarter four sell-off in 2018 because that was partially driven by tighter monetary policy, higher rates. That disproportionately pushed down some of the growth stocks more than the value stocks. So we saw Apple sold off, we saw Adobe sold off, for example. So I used that opportunity to kind of load up on some of those names that had previously, throughout 2017 and into 2018 been too expensive for my taste. And so, we added a bunch of those. Then we got a much quicker rebound into 2019 than I would have guessed, and picked up a couple more in early 2019. For example, Nvidia had that big dip. They got wrapped up in that whole crypto bubble, and then they had that decline. So I used the opportunity to get that. However, we've come so far so fast since then that I have been trimming some of those positions. So I sold Apple at one point, too early it turns out, but I sold Apple when it kind of breached my valuation thresholds. And then just yesterday, we trimmed Nvidia out of the portfolio. We bought that. It was already expensive when we bought it. It was like 9 times sales when we bought it. It had such strong fundamentals. So I was willing to kind of pay up for that one. Now it's something like 24 times sales. And it's very hard to justify that other than kind of using greater fool theory that someone else might buy it more expensive. I can't just kind of go back and say, is this something I want to hold for the next 5 years? So we've been doing some trimming on these growth stocks. And part of the rush is it makes sense because, with the pandemic affecting so many cyclical stocks and value stocks heavily, investors have kind of piled into the sector that has been least harmed, or in some cases benefiting from the pandemic. And so they kind of perceive them as, lower risk. Which is normally not the case for kind of high growth stocks. However, just the valuations make them, the higher you get, the riskier they get. And I think kind of this summer, we've kind of reached some of the problematic levels there.
And do you think there's certain sectors that are neglected by investors?
So I think that international equities, which have performed very poorly over the past decade, I think there are a good amount of opportunities there. And I think that, higher quality value stocks, so not just any value stocks, but I think stocks that are doing fine fundamentally, but just aren't kind of wrapped up in this kind of parabolic valuation increase. So in recent months, we've seen kind of tech stocks, their stock prices went up a lot faster than their fundamentals did. Whereas some of these other industries, you can look at healthcare, you can look at energy, you can look at financials to some extent. Their valuations are quite reasonable compared to the cash flows that they're expected to produce over the next 5 years or so. And I think that there are some opportunities there as long as you can filter out some of the lower quality companies.
And what are some of the metrics you use for quality?
So similar to the Joel Greenblatt screen, which is looking for companies with high returns on invested capital and reasonable valuations. And so there's a couple different metrics to do that. There's return on invested capital, return on equity, return on assets, profit margins, and then looking at the balance sheet side, how much debt do they have? I like to focus on debt relative to income, and just kind of different ways to sort of measure both their safety and kind of an estimate of some sort of economic moat, right? So are their margins paper thin? Are they being pushed out by competitors? Are they going to end up having their cash flows deteriorate faster than analysts think because they're just kind of on the negative side of a trend? Or are they companies that are still doing fine and they're just not growing a lot? So that's kind of the sweet spot I look for, is companies that, their fundamentals are still strong, they're still relevant in the 21st century, but they're just not exciting. And so sometimes if you buy those companies when they're cheap, they can produce very good returns over the next decade or so. And an example I like to use is the tobacco companies of decades ago. So that industry kind of hit secular decline. So for decades, it's just, people are smoking less, which is a good thing. And you'd think that those stocks would have just gotten killed over the past 30 years. But if you look back, one of the best performing stocks over the past 30 years, for example, was Altria, the company of Philip Morris. And that's because, even though growth was slow for many of these companies, they've had strong pricing power. They have high returns on invested capital, and they're basically just cash cows. So all their free cash flow just comes out the door in dividends and share buybacks. And because the valuations are so cheap, reinvesting those dividends or those buybacks, kind of decreasing the share count, they're both kind of very aggressive ways to kind of build equity stakes in the company. And so they've done surprisingly well, especially looking at the top half of that industry, right? They've just done extraordinarily well. And so I think we're kind of seeing that same thing play out in some industries today going forward.
Yeah, understood. And I guess big energy is probably falling into the same camp. It's probably in secular decline now, but they have attractive cash flow features.
That's how I view it. I think if you kind of look at the top half, the top third of the quality side of energy stocks, because many of them are just low quality. They haven't really been free cash flow positive throughout an entire cycle, right? So they're not really kind of in that same camp. But if you look at the ones that have historically been profitable through most cycles, right? So it's obviously really hard to be profitable in 2020 just because energy prices have been so volatile and so low. But if you look at kind of a full cycle, which companies are consistently profitable, they have decent balance sheets, they have very low valuations, they have kind of a proven reserves that can still last them a pretty long time. I think some of these, both the oil producers, the gas producers, and then the transporters, some of the pipeline companies, I think some of them are pretty attractive long term in a very similar way that tobacco was. So you're not going to see a lot of growth out of them, if any. However, just low valuations and then compounded dividends and share buybacks can potentially do very well.
And, you kind of mentioned earlier analysts looking at companies, how analysts would view them. I mean, how important do you think is analyst coverage of stocks?
Oh, it's definitely a factor I look into, right? Because I think that you want to get information from multiple sources. So I do factor analyst forecasts into my valuation analysis to some extent, but you always want to have a margin of safety and do your own kind of due diligence to see, where you might disagree, where analysts might be overstating or understating a case.
Yep, understood. And, on some of the more kind of glamorous big tech names like Tesla, Amazon, do you currently have a view on those or not?
Oh, so I would view those two as quite different. I think Tesla is one of the most concerning stocks at current levels because they're one of those companies that if you just look at the numbers, their revenue, for example, hasn't been growing over the past year. They have a consistent problem with profitability. It's a very hardware focused business. And on the other hand, their valuation is just extraordinarily high because sentiment is huge. So we've seen kind of depending on where you start the measurement from, we had this period where the stock price went up fivefold or tenfold within a very short period of time, but their fundamentals, like their revenue's literally been flat that period. So it's purely been a sentiment driven shift.
I mean, so many people have been trying to short it as well. So I guess that's kind of linked to the sentiment as well, that it's more short squeezes and so on.
Yeah, we had those periods of short squeeze, and now we've had, the last I checked, I'm not sure what happened in the past week or so, but up until this past week, they had some of the lowest, short interest they've had in their company history because all the shorts pretty much got squeezed out and killed from trying to short that stock. Amazon, on the other hand, is more of a wide moat kind of higher quality business. So I don't really put that in the same camp as Tesla. Its valuation, if you look at, so it's always been a challenging company to value from an earnings perspective, but if you look at operating cash flows, they actually trade at a pretty consistent valuation. So their stock price has gone up generally with fundamentals. Now, I think in this year, they started to get kind of stretched. Same thing that happened in 2017. Occasionally, they've gotten a little bit ahead of themselves. But basically, whatever you think of Amazon, at least there's some degree of consistency there. So it's not just like their fundamentals are doing one thing and their stock price is doing something totally different, which is like what we're seeing from Tesla.
And if we round up with some of the other tech guys like Apple, obviously largest company now, what do you make of them?
Yeah, so I've been bearish on Apple recently. We had Apple in the portfolio, but I trimmed it when it started to get pretty high priced. And so what we've seen is kind of a less extreme version of Tesla. So, unlike Tesla, Apple's a very profitable company. They're doing very good work. However, their growth rate is just not that high anymore, right? It's a very big company. They've saturated the hardware side pretty much, and now they're really focusing on building out the software and services revenue from their existing ecosystem. So to some extent, investors are kind of assigning them a higher valuation based on, kind of a somewhat of a shift towards software, somewhat of a shift towards more and more entrenched recurring revenue. So I think somewhat of a valuation premium is justified. However, if you look at the chart of the stock price compared to the fundamentals, it's a very big disconnect in the past 6 months. The stock price went from expensive already and then it doubled, right? So I view it as a case, where the current valuation just doesn't really make sense for long-term kind of forward cash flow production.
Yeah, understood. I mean, there's also been kind of a lot written about how there's only kind of a handful of companies that really drive index performance over the last 5, 10, 20, 30 years even. Do you have like an opinion on that? And if that's true, then does that just mean you have to pick like a handful of big winners to make attractive returns?
Well, that's often an argument for indexing because if you kind of pick stocks, but then you miss some of the big winners, that like the index does better than the median stock in the index, and it's because some of those big winners drive up the whole index. There's kind of different periods where that matters more or less. So this past decade has been a case where we've had some of the highest concentration in the S&P 500 as we've seen in 40 years. So you have to go back about 40 years to find a time where the top five stocks had a bigger percent holding of the S&P 500 as they do now. So we've kind of seen that big kind of tech platform build out. One thing I do is I like to compare the S&P 500 compared to the equal weight S&P 500. And if you kind of look at relative performance over time, going back decades, and you can kind of extend the data set further by looking at Wilshire large caps. And because they have that same index breakdown. And what you actually find is that the equal weight large cap index outperforms over the multi-decade long term. So by rebalancing quarterly, they get out of some of those big momentum names, and they kind of it's the same set of companies, and it's just weighted differently. What we tend to find is that later in the business cycle, the equal weight tends to underperform. And especially during a recession, usually you have kind of a leadership change. So you get kind of a blow off top, and then you get kind of a rotation leadership. And so we've had this 5-year period where equal weight has just gotten absolutely crushed by market weight because we've had kind of the top stocks just get more and more and more expensive. And so one thing I've been tracking is to see if that's potentially going to shift back, because we're kind of at the time period now where we are in the cycle where you'd expect to start to see kind of a rotation back to the equal weight index outperforming. But it's, you got to confirm it with price. So I'm kind of using that as my base case, but then I'm kind of monitoring that ratio to see if it keeps making lower lows, or if it starts to kind of show signs of reversing.
And does that return back to the equal weighting index? Does that tend to happen during recessions? Just as you come out of a recession, I mean, is there a connection to the business cycle, or is it unrelated to the business cycle?
No, exactly. Yeah. Basically, as you get later in the business cycle, the market weight version tends to do better. Whereas when you go into recession, usually that gap widens even further, right? So, but then when you're at kind of the bottom of recession, you're kind of working your way out of that. Usually you get the rebound in the equal weight compared to the market weight. So you get that, the winners that did well are very highly valued. And then some of the sold off companies that the equal weight has kind of rebalanced back into, those start to kind of pop back, and some of the previous leaders kind of sag a little bit under the weight of their own valuations, or under the weight of just so much sentiment that kind of piled into them from the previous cycle. So we are at the stage earlier in the business cycle, either kind of already experienced first half of a recession, right, and then kind of coming out of that to some extent. That's when equal weight historically does a little bit better. The cycle that was kind of most different was the dot-com bubble, because you had the sheer size of that equity bubble and the length of that bear market kind of had different timing. However, most cycles, that's generally how it plays out, is that kind of equal weight sort of leads the recovery. But, it could always be different.
Yeah, of course. And I've seen that you've done some work on how taxes in the US have affected different company performance, and the benefits are accruing to companies with not that much labor, that don't employ that many people. And as a result, workers kind of lose out, either through lower wages or through being outsourced to another country. Do you want to talk a bit more about your thinking there?
Yeah, so over the past several decades, we have our tax policy and just other policies that strongly favor these businesses that are not very labor intensive. And there's a couple of different ways that we've done that. One is that the corporate tax rate, which tax companies at the point of profit, that's gone down and down and down. So in addition to the headline number decreasing, the actual effective tax rate, so it's the tax rate plus all the different things that can kind of change the actual number when they pay it. So if you look at the effective tax rate for corporations in the US, it's gone down every single decade for several decades straight. However, we had that kind of ramp up in payroll tax rates, and then that eventually leveled out. However, employers are still paying a big chunk of the health insurance for their employees in many cases. And that's continued to go up at a much faster rate than broad inflation, for example. We've had kind of a steady kind of 5% increase in healthcare costs every year for a while. And so the US, for example, has the highest healthcare costs in the world per capita by far. There are a couple of countries that are kind of close, but if you look at the average of developed nations, the US is close to twice as high as the average country in Europe or developed Asia. And so that puts a lot of pressure on labor-intensive businesses. And so what we've generally seen is that effectively, if you have a very labor-light business, like you're a software company or a high-margin tech company, or if you're a labor-intensive businesses that manages to offshore or shift out a lot of your employees to other places of the world, you can do very well. And so it's just kind of an interesting tax, and policy choice, because we've really kind of, by taxing the system as we do, we really kind of incentivize these mega cap tech companies to kind of keep eating their competitors, because that's just kind of how we've structured our tax policy.
And obviously we have a US election coming up. I mean, do you think elections are important for equity investors or not?
I think to some extent, because we're in a very macro heavy environment where the amount and type of fiscal spending is probably going to play a very big role in both how certain economic indicators work out, as well as how markets obviously respond to that. I've been looking at it less in terms of who wins and more in terms of whether or not there's gridlock or a decisive victory. So if you have, say, for example, Biden wins the presidency, but Republicans hold the Senate, that's a very different environment than a blue sweep, for example. Same thing as if you have a Trump win, you have Republicans hold the Senate. Basically, there's a couple, instead of just kind of two outcomes, I view it basically as four outcomes, right? It's kind of like who wins the presidency, and then do they have kind of Congress more on their side or not? And I think that kind of plays a big role.
I guess the question then is, what's the best outcome for markets? Is it gridlock when you have a split executive and Congress, or is it clean sweep better for markets?
I think it depends on the circumstance. So I think because we're in an environment now where it's so fiscal heavy and so reliant on fiscal spending, I think markets would probably do better with a sweep in one way or the other, because you're going to get more spending most likely if there's a sweep. However, if there's a gridlock, there's less incentive for them to work together. So I think in many environments, gridlock's actually better, because you don't really want anything out of Washington, and you want to let the markets kind of continue doing whatever they were doing. So that's what we saw, for example, the last 6 years of the Obama administration were pretty split, and just kind of there wasn't a lot coming out of Washington, and the markets were just kind of doing their own thing. Whereas if you get kind of that one-sided outcome, it really kind of depends what it was. So for example, the first 2 years of the Trump presidency, for example, were very good for markets because they were able to pass that tax cut that benefited corporations. That's an example where a sweep in many, kind of really helped markets. And then the past couple of years, it's been more of a gridlock. So it really kind of depends whether or not the market thinks it needs something out of Washington or doesn't. And I think right now, because the economic hit is so big, I think that we're in a very macro heavy environment where kind of a lot of fiscal reliance.
Yeah, that makes sense. And as we kind of talk about politics, I mean, the US has been having some kind of a Cold War, tech war with China. Do you factor that much into your thinking?
To some extent, yeah. I think there's definitely a risk there. I think that it's also opened up some opportunities, though. So I think I'm reasonably bullish on some of the Chinese tech stocks. I think their tech stocks are more reasonably valued than U.S. tech stocks, and I think it's some cases warranted, right? Because you have to kind of discount Chinese equities differently than U.S. equities. There's a higher risk of accounting fraud. There's higher just jurisdictional risk in general. But I think as part of a diversified portfolio, there are some opportunities from kind of the whole Asian region, including China. But there are certain risks that can happen. And one example we saw is that the thrift savings plan, which is the retirement system for federal civilian employees and for the military in the US, it basically uses all index funds. So they have an S&P 500 fund, they have a small cap fund, they have bond funds, and then they have an international fund. And the international fund, since its inception almost 20 years ago, has followed developed international markets, so the MSCI EAFE index. And they were going to expand it to include kind of an all-country index. And so they were going to include emerging markets, and that got pushback from Congress and the president. And so that was actually put on hold. So what would have been kind of a boring kind of asset allocation decision to kind of make the TSP kind of match up with what Vanguard does for their retirement funds, for example, was instead kind of politically blocked, because you get the narratives of putting soldiers' retirement money into China, which doesn't sound great. So you kind of have that situation where what if Vanguard does it, it's not politicized, but if the TSP does it, it is politicized. And that specific example only affected about $5 billion, because it's, they have the $50 billion I fund, and then 5 billion of that would have gone into China, a few other billion into other places. So it wasn't really a big number in the macro sense, but it's kind of an example to be aware of.
Yeah, it's a kind of a warning shot almost.
Yeah, and it's possible you could see more of a financial decoupling. And I think that if that were to happen, that would have bigger effects. Like if we were to see kind of sanctions or kind of a problem with index funds, on a bigger scale.
Yeah, understood. And, are there any specific companies you like in Asia?
I like Tencent. That's one of the ones I've been looking at a lot recently. I'm pretty bullish on them. I think that they're, even though they're a high valued company compared to the expected growth rate, they're still pretty reasonable in many cases. So I am pretty bullish on Tencent, and I think that just the whole kind of area is reasonably attractive from an equity perspective.
And in Europe, do you have any favorite companies or sectors or countries?
Not strongly. No, I found some value in Unilever, for example. I think that it's not my favorite equity region, and for several years I was bearish on it. So from about 2016 to like 2018, I didn't really want to touch Europe, but it's kind of underperformed so long, and that it's actually compared to what some of the market weighted US indices look like, I think Europe is actually reasonably attractive at the current time. It's still not my favorite. I prefer some of the emerging markets a little bit more than Europe, but I do think that it can kind of serve a role in a portfolio. Not very stock specific there.
Yeah, understood. And if we kind of move more to kind of the debt side, the Fed has expanded its balance sheet massively. There's a huge growth in debt around the world. Number one, how does that sort of factor into your investment views? And secondly, just a very simple question, how does it all end?
So we're in like a kind of a challenging part of the long-term debt cycle. And I think Ray Dalio's work on this has been particularly kind of useful, for my kind of own understanding of how this kind of works out in history. And so we have the short-term business cycles that kind of all you build up leverage and then you have a recession, you deleverage, but you never really deleverage all the way back. So you get kind of lower interest rates, you get higher and higher debt rates. Eventually, interest rates hit the zero bound and debt is extraordinarily high. And historically, that gets devalued through some degree of currency devaluation, right? Because the nominal debts are so high that trying to deleverage them just results in more and more cards falling on each other, and just it's almost impossible to do. So what usually happens instead is you get some degree of currency devaluation. And that can take a couple different forms. It can take different magnitudes depending on kind of how much the productive assets of the country are maintained, right? So of course you have some extreme examples of hyperinflation, but then you have other cases of just like a 30% currency devaluation or a 50% currency devaluation. And so basically, I expect that sovereign bond yields will be below their prevailing inflation rates for quite a while, which is what we saw in, kind of the last long-term debt cycle, which was the 1930s and 40s. That's how long these things normally take to play out. So that's kind of my base case, is that bonds and cash in general are going to be very poor, for quite a while. And then to the extent that that kind of accelerates and gets extreme, I think partially depends on policy choices and overall kind of economic growth. I think you could have a case, later in the 2020s where you get kind of an inflationary shock. However, at the current time, it's, there's so much debt overhang that we're kind of more on the disinflation side.
And what do you make of the Japan case, both in terms of managing its own debt and also in terms of the Nikkei? Obviously since the 80s, it's never quite got back to those levels before.
Yeah, often when people talk about debt, they point out the Japanese example because they have the highest sovereign debt in the world as a percentage of GDP, and they've kind of pushed that for years and decades with no real kind of major consequences other than economic stagnation. One thing, there's a couple kind of key aspects to them. So there was a study, I forget who did it. They showed that basically over the past 200 years, 51 out of 52 sovereign nations, once they hit 130% of GDP, they went on to have some sort of default, either in real terms or in some cases nominal terms. And the one example that didn't do it was Japan. And so they have been the exception. And there's a couple, I think, reasons for that. So ever since the past couple of decades, they've been the world's largest creditor nation. So we often focus on Japan's liability side, like their huge amount of debt relative to their GDP. However, that's mostly internally owned, and they own a ton of foreign assets. And so they have the largest debt international investment position in absolute terms. And then as a percentage of GDP, it's also one of the biggest. It's not as big as some of the more city-state type places like Singapore, but in terms of major nations, they have one of the highest net international investment positions as a percentage of GDP. They have a positive current account balance. They have a very kind of unified population. So there's not a lot of political polarization there compared to, there's always drama, but there's not as much as you see in Europe or United States, for example. And so all those factors kind of come together to give them a degree of stability, which is unusual. So I think one potential mistake that a lot of analysts are using is to kind of assume the world's going to all become Japan. And I think we're in some areas we are, like in terms of, for example, demographic stagnation. However, the United States is the world's largest debtor nation, so we have a deeply negative net international investment position. And then as a percentage of GDP, it's not the worst, but it's among the worst of major countries. And so I think our path is going to be somewhat different than Japan's path throughout that. I don't think we can kind of just look at Japan and say that's exactly how we're going to turn out. Japan's also an example where, they've had that 30-year equity bear market, and it's because they were so highly valued back in the late 80s and early 90s that even though some of their companies continue to do very well, there was just no way to justify those high valuations. In many cases, that was a bigger bubble than the dot-com bubble, right? In terms of the sheer level of valuation that they got to. So I think it's something to be aware of, that you can have. Back then in the 80s, it was kind of like you couldn't go wrong in investing in Japan. Any sort of high valuation was justified by saying, well, it's Japan. They're taking over the world. They're growing like crazy. And so both the real estate, it's kind of like if you had the dot-com bubble and the real estate bubble kind of at the same time. So that's pretty much what they had going on there. And so I think it's kind of it is something that investors should be aware of when they're valuing some of these big US tech companies, for example.
And now I know you have some views on gold and Bitcoin as well. So I'd like to kind of hear them.
Sure. Yeah, I turned bullish on gold and silver in late 2018, around autumn 2018, and including the miners as well. And so they've done very well as we've got kind of the declining real rate environment. So as nominal treasury yields came down faster than the prevailing inflation rate, we went from positive real yields to negative real yields. That's historically very good for precious metals. So up until March of this year, gold was outperforming silver, but then out of that kind of crash low, we've had silver outperform gold, which is pretty normal in that more reflationary environment. And we got pretty far ahead of ourselves, I think, and kind of the last couple of months we've had this period of consolidation, which is good. Long term, I continue to be pretty bullish on precious metals in this environment because I think that the amount of stimulus is probably coming worldwide over the next, call it 3 to 5 years, is pretty high. And I think combined with the fact that where we are in the long-term debt cycle, and that interest rates are likely to, sovereign interest rates are likely to stay lower than the prevailing inflation rates for quite a while, is an environment that really favors precious metals, in my opinion. So I'm pretty bullish on those.
Yeah. And Bitcoin?
So Bitcoin, I mostly ignored for the past several years. I analyzed it in 2017. I decided not to take a position, and that it had that blow off top bubble. Then it had a crash. Then it had a period of consolidation. And so in April of this year, I did turn bullish on it as a small position. And it kind of, so if you look at Bitcoin's history, they have halving cycles. So every 4 years or so, the amount of new Bitcoins coming onto the market gets cut in half. And historically, most of the bullish price action happens in the first half of each halving cycle. So the first 2 years after each halving is when most of that pretty much all of that bullish price action happens. And then you have the consolidation in the second half. The combination of where we are in Bitcoin's halving cycle, so it had its halving in May of this year. We're several months into the halving. So from now until about the end of 2021, I am pretty bullish on Bitcoin. I think it has kind of it's because it's still a pretty small market cap, and there's still kind of so much investor interest in it. So there still is capital flowing into it at a time when new supply is limited. So I do think that kind of the network effect of that cryptocurrency is very strong. And so I think that, whereas the previous 2 years I was more focused on gold and silver, the next, year and a half, I am pretty bullish on Bitcoin.
Yeah, okay, makes sense. Well, I think we've covered lots and lots of markets, unless there's anything you think we've missed.
No, I think that covers it. I think the next 5 years are going to be very interesting. I think it's going to be a very macro heavy environment, and it's going to be a time where you want to have kind of some asset classes other than maybe just the broad equity indices.
Yeah. Now, I always like to ask my guests some more personal questions. One I think I'd love to hear from you is, how do you kind of manage all your information and research flow? I mean, there's just so much data, news, information, and from the looks of things, you cover so many different companies, sectors, markets. How do you manage that overload?
So for me, the biggest thing is defining my time frame, right? Because there's always a temptation to be every time frame. Like you want to be right in the short term, you want to be right in the long term. Whereas, because of the scale that I focus on of the macro policies and of the fundamental camp rather than the technical camp of individual stock analysis, I really kind of focus heavily on the medium to long term. and ignore the noise in the short term. And that choice alone just filters out a lot of the things like the headlines, individual kind of quarters, short-term technical signals. I filter a lot of that out, and I focus on what's going to do well over a 5-year period or more. And I think that kind of filters out a very big chunk of the research.
Yeah. And you have kind of a day job at an engineering firm. You run your site, you do your research, you make your recommendations, you do your trading. I mean, that's a lot to fit into 24 hours. So what's your secret there in terms of your personal productivity? How do you fit everything in?
Well, one is just passion. I wouldn't be able to do it if I wasn't so passionate about it. And it's almost like it's like an addiction. It's literally a fun thing to go look up and see macro or make 100-year charts of monetary policy. Like you have to be in that kind of weird mindset in order to make something like that work, despite being so busy. But mainly, from a practical standpoint, I batch things, right? So I kind of have one period of the day where I do all the emails, another period of the day that I set aside for writing and research, another period of the day that I obviously focus on engineering and managing the finances of that facility. And so just kind of breaking things down into different kind of time frames is how I'm able to kind of make sure that I get each area done in a day.
Okay, yeah, that's great. And I'm a big fan of books. I'm reading all the time. And so has there been any one or more books that have really influenced you in the way you look at the world?
So I think, especially as it pertains to macro, I think Ray Dalio's Big Debt Crises. It was released a couple years ago, and I think that work, it kind of helps show, inflationary currency crises versus deflationary debt crises, for example. Like why do emerging markets tend to have more inflationary outcomes versus developed markets? What could some of the exceptions be? And then deep dives into some of the big debt bubbles of past history. I think it's been a very useful book to kind of see how kind of the end game can play out.
Yeah, no, that's great. Well, it's been great chatting to you, and I'd kind of urge all of our listeners to follow you as well. And what's the best way for people to follow your work?
So I'm at LynAlden.com. That's a good way. And then on Twitter, I'm at Lyn Alden Contact. And those are the two places where I'm really active.
Okay, so I'll add that to our show notes as well, so people kind of have the links there. So with that, just thank you very much. That was an excellent conversation.
Yep, thanks very much for having me.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.